Welcome to Explain the Charts, where we break down the most significant market movements to help you trade with confidence. Today is March 22nd, 2026, and we are focusing our attention on the XAUUSD pair, which has seen unprecedented volatility in recent weeks. The current news landscape for gold is dominated by the fallout from the latest Federal Reserve interest rate decision and ongoing geopolitical conflicts. Headlines suggest that gold recently slumped despite active warfare, exposing what analysts call crowded trade risks as real interest rates began to rise. Just a few days ago, on March 19th, XAUUSD reportedly plunged by as much as 17%, breaking through key support zones that had held firm since the start of the year. Geopolitical tensions in the Middle East, particularly between the US and Iran, initially pushed prices to record highs earlier this year, but that momentum is now fading. Investors are becoming increasingly cautious as the Fed signals higher for longer inflation expectations, which typically puts downward pressure on non-yielding assets like gold. Additionally, a stronger US dollar and rising oil prices above $100 have complicated the outlook for XAUUSD as they delay potential rate cuts. As we prepare to look at the charts, we need to consider if this recent crash is a healthy correction or the start of a long-term bearish trend. Let's look at the data to see how these news events have manifested in the price action. Starting with the one-day chart, we can see the meteoric rise that occurred throughout late 2025 and into early January of this year. Notice the massive candle on January 28, 2026, where the price surged to a close of $5,523 with an intraday high reaching nearly $5,600. This peak was driven by the height of the US-Iran war tensions, marking the absolute psychological ceiling for gold in this cycle. However, the reversal was swift. On January 30th, we saw a staggering 10% drop in a single day, taking us from the $5,400 handle down to $4,884. This specific range between $5,500 and $5,600 now stands as a massive zone of resistance that will likely not be challenged for some time. Throughout February, the market attempted to stabilize, oscillating around the $5,000 psychological mark. But as we look at the most recent daily candles in March, a new bearish leg has clearly developed. The price was unable to sustain a recovery above $5,200, leading to the current breakdown we are seeing today. Currently, on March 20th, 2026, the market closed at $4,490, which is a significant departure from the all-time highs seen just months ago. This breakdown below $4,800 is a major technical signal that the short-term trend has shifted firmly to the downside. Narrowing in on the one-hour chart from early March, we can witness the struggle at the $5,400 level more clearly. On March 2nd, the price made a final attempt to push higher, reaching $5,418 during the European session. By 1400 hours Universal Time Coordinated that same day, a sharp sell-off occurred, dropping the price over $60 in a single hour. This was the first major warning sign that the bulls were losing their grip on the $5,300 support zone. The following day, March 3rd, the price collapsed again during the US session, plunging from $5,247 to a low of $5,014. This high-volume rejection coincided with Fed commentary regarding the persistence of inflation, which caught many traders off guard. You can see how the price attempted to consolidate around $5,100, but every bounce was met with heavy selling pressure. This pattern of lower highs on the hourly time frame is a classic indication of a distribution phase before a larger move south. Each time the news cycle brought a hint of a hawkish Fed, the chart responded with a new leg lower, ignoring any safe haven bid from the war. This correlation highlights that monetary policy is currently outweighing geopolitical risk for XAUUSD traders. Now let's look at the 15-minute chart to analyze the price action from this past week, specifically March 18th through March 20th. On March 18th, we saw a relatively stable market around $5,000 until the afternoon when the floor dropped out. At 10:26 Universal Time Coordinated, the price started to slip from $4,986, and by the end of the day, it was struggling to stay above $4,800. The most dramatic movement occurred on March 19th, where the price plummeted from $4,840 all the way down to a low of $4,502. This 1,500 pip crash mentioned in our news reports is visible right here in these cascading 15-minute candles. There was a brief moment of consolidation near $4,600 on March 20th, but the market ended the week at its absolute lows. The current price of $4,490 represents a critical juncture for the market. Look at the volume and transactions during these drops. They were significantly higher than the preceding consolidation periods. This suggests that large institutional players may have been liquidating their long positions, triggering stop losses for retail traders. Short-term, the trend is extremely bearish, and any rally into the $4,700 area should be viewed with skepticism until a higher low is established. Returning to the daily view, let's summarize where XAUUSD stands and what we should look for in the coming days. We are currently testing a major support level near $4,475, which was the low of the most recent candle. If this level fails to hold on the daily close, the next significant support doesn't appear until we look much further back into the $4,000 to $4,100 range. On the bullish side, a recovery and close back above $4,800 would be the first sign that the bleeding has stopped. However, the long-term outlook remains clouded as long as the Fed maintains its current hawkish stance and the US dollar remains strong. I believe a continuation of the bearish trend is highly likely, perhaps about a 65% chance, especially if upcoming economic data remains hot. A neutral consolidation between $4,400 and $4,700 is also a strong possibility as the market digests the recent 17% plunge. I would only become long-term bullish again if we see a clear reversal pattern on the daily chart, such as a double bottom or an inverse head and shoulders. Key levels to watch are resistance at $4,800 and $5,000, and support at $4,476 and $4,250. Be careful with leverage in this environment, as the volatility we've seen on the 15-minute chart can wipe out accounts very quickly. Keep a close eye on any news regarding US-Iran de-escalation, as that could remove the last bit of the war premium from gold prices. Conversely, if the conflict escalates further, we might see a buy-the-dip scenario, though the technical damage is already severe. Remember to watch the 10-year Treasury yields, as their rise has been a primary driver of this recent gold sell-off. Always wait for price confirmation at these key levels before entering a trade. In summary, the trend has reversed from record highs to a steep decline, and caution is the name of the game right now. Thank you for watching Explain the Charts, and make sure to subscribe for more in-depth analysis of your favorite assets. Please note that this video is for educational purposes only and does not constitute financial advice. Trading involves significant risk, so always do your own research and consult with a professional before making investment decisions.